Okay, folks, how many of you are going to be gone next week, the spring break? To take your DCF to the beaches with you, or the bars, or wherever you are, Or maybe take your Tesla valuation around, Conversation piece, right? So today we're going to talk about valuing companies, and I'm going to call it, the dark side of valuation. Sounds ominous, but it's about valuing companies where valuation is difficult to do. And let's face it, that's what this class is really for, because companies are easy to value. Let's face it, you don't need this class, right? Mechanical, you just extrapolate the past. So I'm going to set up the process today because these are some of the issues we're going to run into. We talk a lot about corporate governance in corporate finance. And in many ways, we've lost our way on it because we talk about boards of directors and independence and Sarbanes-Oxley. But let's talk about corporate governance from a valuation perspective. Let's say you have a company which has poor corporate governance. And I'm going to let you in your mind decide what that means. Let's say the firm is badly managed. You've done a discounted cash flow valuation of this company and come up with a discounted cash flow value of 100 million for the company. Everybody with me so far? But there's bad corporate governance. Should you be discounting the 100 million for bad corporate governance? What do you think, Wow? And how do we know it's embedded? Because you did the DCF, right? So in a sense, if you do the DCF, you did the cash flows, and if it's badly managed, you reflected that in the cash flows, it's already there. If somebody else has done the DCF, don't assume it's already in there, right? You got to ask them questions. But if you do your intrinsic valuation right, what if this were a well-managed company? You think, well, shouldn't it be the same? I'm going to come back to you. If it's a well-managed company, should I be attaching a premium to the company? The problem with the well-managed company is you build in the fact that it's well-managed into the cash flows, right? But if it's bad corporate governance, what's hanging over your head? Do well-managed companies stay well-managed in perpetuity? Not necessarily. Maybe the people managing the company now might pass on. The next generation might not be as strong, or the person running the company kind of goes from being a good manager to a bad manager. It's a challenge you face when you value well-managed companies where you worry about corporate governance. You might actually overvalue the company if you don't factor in the chance that at some point in time, it's for the last 20 years, this has basically been the thing that troubled me the most about the great tech companies, right? Starting with Google, what have they done? They've skewed the corporate governance game by issuing voting and non-voting shares. So when you bought Google in 2004 or Facebook in 2012, you might have thought about the people running the company then as being great founders, great managers, but there's always a chance, right? And then after the fact, of course, you wake up and say, I wish I'd attached that discount. It happened with Facebook after the metaverse fiasco. But corporate governance is tricky because it's not just locking in. So bad management, we can actually deal with. But good management, I think you always have to say, what is the chance that that could change? So we'll talk about corporate governance. Second, made a big deal about capitalizing R&D. Actually, you didn't, but I did, and I made you make a big deal of it because you had to do it in the quiz, but your heart might not have been in it. So let's say you take a pharma company, you take conventional accounting. You know what I mean by conventional accounting, right? The traditional accounting statements that R&D is expense. You value the company and you come up with a value per share of $20. Then you go, if my spreadsheet, you just say yes to the R&D, you capitalize R&D, and I magically change all your numbers, right? Your earnings get restated, your return on capital gets restated, the sales invested capital gets restated. But my question is about the bottom line. Ultimately, we care about value per share. Will my value per share remain the same because money spent is money spent, whether it's capital expense or operating expense? If you believe that, then what should we be doing about R&D? It's doing nothing to value per share. Why are we wasting our time, right? So if I believe that, I wouldn't have spent the 30 minutes or 45 minutes making you go through that torture. So clearly that's not the answer. So now the question, if I capitalize R&D for a pharmaceutical company, will my value go up because of higher earnings? Or will my value go down because of higher reinvestment? Or could the effect be different for different companies? What's it good? And if it's D, what will it depend on? Anybody want to give that a shot? When? What, right? Wait, I'm sorry. When we capitalize R&D, what are we doing? We're bringing it to the same level as every other investment, right? And what's the effect of an investment on value? It's a good investment, it'll increase value. And the way we measure good is the return on capital you're making on the investment greater than the cost of capital? In a sense, we're bringing R&D to that same test. Now I'm going to come back to you. So when you look at a pharma company and I capitalize R&D, will R&D increase or decrease value? And if so, what will it depend on?
Capitalize R&D is to bring your net income up.
The earnings, so we know the effects. Earnings will be up, return on invested capital will be down, reinvestment will increase. So the effects are mechanical. But why might the effect push up the value in some companies and push down the value in others? Gabriel?
Success.
If it's good, not even if it's successful, you have a portfolio of R&D. If on average you are good at doing R&D, R&D by itself is neither good nor bad. Just like innovation is neither good nor bad, right? You can talk about innovation in society being great, but in a company, innovation makes sense only if you can create value from it. R&D is good only if you can create value. What we're doing is we're separating the good R&D companies from the bad R&D companies. I'm going to show you my value for Amgen. So way back in time, a couple of years ago. Their capitalizing R&D increased the value per share. I also valued Merck at exactly the same time. And guess what the effect was there? This is a company that has spent $100 billion in R&D and has very little to show for it a decade later. And my valuation would reflect the fact that you're doing R&D. You're throwing good money after bad money, trying to make money back. And that's the reason we capitalize R&D, because we need to ask that question about a company. We take it for granted. And I think I blame business schools that R&D is good, innovation is good. Test who? You're a business. If you're a basic research lab, R&D is good. That's your job. But if you're a business, your job is not to do R&D for the sake of doing R&D. That R&D has to convert into products and earnings and cash flow. Sounds incredibly mercenary, but that's what a business is, right? Finally, we're going to talk about distressed companies. When we say distress, what are the pieces that go into a distressed company? Money making or money losing? Usually money losing. And if it's distressed, usually there's a lot of debt overhanging the company. And I ask you to value a company. You know the mechanics of how to fix a distressed company in a spreadsheet, right? What do you have to do? You got to grow the revenues out, make the negative into positive, bring the debt. It's all easy to do on a spreadsheet. And you do it all the way we go through the mechanics. And by the time you're done, what do you have? You have a nice money-making company with a sustainable debt ratio, and you're in year 10, you put a big terminal value, you discount it all back, and you get a value of $1 billion for the equity. Job well done, right? You fix the problems on the spreadsheet. I think that even if you've done everything with reasonable numbers, you've overvalued the equity in the company. Why is that? Jacob, what have I missed? Hard is never the reason, right? Hard is basically it's not just that it's hard. This is the value if the company makes it back to health and becomes a viable company. But if it's a distressed company, what's hanging over their heads? They might not make it. And you know what? You can't bring that into a discounted cash flow valuation. I know you're saying, but the D, I can raise the D. It's not going to work. Discount rates are blunt instruments. They were never designed to deal with truncation risk that your company will not make it. You will overvalue distressed companies in DCFs because you're ignoring the very real probability that these companies will not make it. And that is tough to bring into DCF. So today we're going to talk about what to do with distressed companies. And in your mind, I want you to start thinking about what am I missing? The chance that they'll go bankrupt. How do I bring that into valuation? And I want you to think decision trees. Remember the two branches? And in a sense, that's going to be the basis for how we're going to think about this or any other discrete risk. So lots on our plate. Let's get the process rolling by setting up the dark side of valuation. So I'm going to go back to the very first session of this class, where I talked about what drives value, the intrinsic value, first two sessions. When we think about intrinsic valuation, now we think of Excel spreadsheets, we think about inputs, but basically there are four questions you're asking and answering about a company to value. First is, what are the cash flows you're generating from your existing investments? Your answer could be nothing, it could be huge, it could be negative, cash flows of existing assets. Second question is, what is the value you're going to add or destroy? I should have added that word, by trying to grow. Why add or destroy? Growth is a good thing in terms of increasing revenues and earnings, but growth also requires reinvestment. The net effect can be positive, negative, or neutral. Third question is, how risky are your cash flows? Notice I'm stating these questions generically. I'm not asking you, what's your beta? I mean, you can have different measures of risk, but fundamentally, you still have to bring risk into your discount rate. And finally, ask, when will you be a mature company? Joe, why do I need the answer to that? Because then I can put them into stable growth. At the risk of stating the obvious, when those questions are easy to answer, valuation becomes easy. So when do you think those questions are easy to answer? What kind of company? Mature company, but let's keep going. Mature company in a business that is not being disrupted, because you can be a mature company in the automobile business, and guess what? The whole world is coming apart under you. With a long history and a management team that is kind of in there and kind of locked into whatever they're doing. You're valuing Coca-Cola. The questions are easy to answer. But when will those questions be difficult to answer? With young companies. Why? Because they're still being formed. With companies that don't fit the accounting mold. The first time I wrote this, I misspelled mold as the mold that grows underneath. I'm still not sure whether it's M-O-U-L-D or M-O-L. I think this is the right version of mold. Don't fit the accounting mold in what sense? Well, a manufacturing company, everything works the way it's supposed to in accounting. Any company other than a manufacturing company, you're stretching, right? You got to capitalize things, you got to expense things. And finally, companies that face significant truncation risk. We talked about one, distress. What else could cause truncation? I know I had a student of mine who lives in Venezuela, still has a business, and he called about valuing his business. And I said, the thing he's most concerned about is that his business is doing too well. I said, why is that concerning you? He said, we're doing so well, the government is watching us. And I said, why is that concerning you? I said, because they might decide to nationalize the business. And when you get nationalized, I'll tell you one thing I can guarantee, you're not getting fair value. You might get book value, half of book value, or nothing. He said, how do I bring that into the valuation? And you can think of variants of this, right? Discrete risk, nationalization risk, regulatory risk. So we're going to talk about all of those companies. So I'm going to set the table on the kinds of companies I want to cover in this section. First, in today's session, I want to range across the life cycle. I'm going to start with my favorite part of the life cycle, young companies. I may be strange, but I like dealing with uncertainty. I like facing up to uncertainty. I like looking at things where everything hasn't been set in place yet. I feel like I can tell the story. I could be wrong, but so is everybody else. So we're going to start with young companies. Second step, we're going to look at mature companies, but where there's something significant happening underneath. An activist is challenging them and they might have restructured, the business is changing. And finally, I'm going to look at declining companies. And I'll be quite honest, I don't like valuing declining companies. They make me feel like I need to take a shower every 5 or 7 minutes. You value brick and mortar retail companies in the US. There is no happy story, right? It's going to be a horror story. The only question is how much carnage, how much blood before the whole thing runs out. So companies across the life cycle. Then I want to talk about across markets, emerging market companies. I've seen entire books on valuing emerging market companies. I don't get it. The value of a company is the value of a company. Cash flows, growth, and risk. The fact that you might face challenges in getting growth rates and discount rates doesn't mean you write an entire book on how to, because then you create your own rules as you go along. I'm not going to, but I'm going to talk about the things you deal with emerging market companies that aren't unique to them, but still might be specific to them. And finally, I want to talk about valuing companies across sectors. I'm going to focus particularly on banks, and I'm going to tell you something about how I thought about valuing banks before 2008 that I have to get over. In all of my books that were published before 2008, I have either a section or a chapter on valuing banks that starts with a line that I've never been able to live down. It says, valuing banks is easy. And I'll talk about the assumptions I made before 2008 that led me there and why those assumptions don't hold anymore, how I value banks now. I want to talk about valuing commodity companies. I think what's unique about them? What's a feature about commodity companies that makes them messy to value, even a mature oil company? Michael, what is it?
They don't control the price.
The biggest factor, the uncertainty you have is not about the management, the reserves, it's about the oil price. It's a macro variable. It's an outsider in your story that you don't control. It's like that eccentric alcoholic uncle who pops into the story, changes the story, and walks away. And you don't know when he will show up. So we're going to talk about what to do with companies where there's a macro risk component. And finally, I want to talk about the pharmaceutical companies. I'm going to take Amgen and show you how the R&D effect plays out and why we spent the time that we did. So let's start with young companies. And Constantine, you're going to be my guinea pig here. You've started a very promising AI business. You just started it last week. Lots of promise and potential, right? So I'm going to ask you the 4 questions about your company that I need to know the answers to, and try your best with, given that it's this form. First, what's the value of what are the cash flows you get from your existing assets? Nothing. You don't even know the chair you sit in, right? That was easy. We get that out of the way. There's nothing there. What's the value of future growth? A lot. Don't say anything. You're the founder. You got to say a lot. Say, beyond that, how much more can you say? You don't know the market. You don't know your product. How risky are you? Very. But beyond that, what can you do? You can't show me past history. And I ask you, when will you be a mature company? You fall out of your chair laughing. You don't even know whether you'll make it through next week. Now do you see why most people don't even try to value young companies? Every question becomes incredibly difficult to answer. That's the excuse VCs give for never valuing young companies. Too much uncertainty. I don't know what the answers are. So I'm going to set the table on why young companies are so problematic. When we value companies, we're constantly looking for crutches. You know what I mean by crutches? Something to base our numbers on, because then we can blame somebody else if the numbers go wrong. So what's the first thing we look at? We can look at the company's current financials. That 10K becomes almost a Bible. You go through it, you reverse it, and you read it backwards, you read it forward. You get AI to read it to you. What are you looking for? Clues on growth and profitability and reinvestment. Then you look at the company's history. What are you looking for in the company's history? Is it cyclical? Is it risky? Is it volatile? And then to console yourself, you also look across the industry. What are you learning there? You're learning what happens to margins as companies grow and scaling effects. You look at the company's financials, you look at its history, you look at its comparables. One by one, I'm going to knock your crutches out. You're valuing a young company in a business where every company looks just like your company. They're all young, unformed companies. So your financials tell you very little, right? You're a young company. What am I learning by looking at your financial statements? You have no history, so that's gone. You look at other companies, they look just like yours. Congratulations, you hit what I call the valuation trifecta. You have no crutches. And some of you are valuing companies like these, where you say, I have nothing to base my numbers on. And that's when the dark side will beckon. What does the dark side look like? It says, oh, the old rules don't apply, that making money, it's so 20th century. cash in, cash out. That's not what we look at here. You invent metrics that nobody's seen before. In fact, the example that I just gave, young companies, every company is like your company. In the 1990s, what was I describing? The dot-com companies, right? Every company, young, unformed. What were the metrics that were invented? Anybody remember? Michael?
How many times someone viewed their web?
Market value per website visitor. And then Mary Meeker said, that's not sophisticated enough. Mary Meeker was the Morgan Stanley.com analyst, became a legend in the decade. She said, it's not just how many people, but how long they look at your webpage. She created market value per eyeball. Here's the problem with these metrics. If I told you the market value per eyeball is 250 and asked you, is that a high number? Is that a low number? What's your reaction? I really like my eyeball. 250 doesn't sound like that much. Maybe it's even cheap. The problem with these metrics is you have no frame of reference. And when you have a metric where there's no frame of reference, you have no idea what's high, what's low, so you pay whatever everybody else is paying. And every company you confront about why you're worth a lot, what's the answer you get? A macro story. .com is going to be incredible. Everybody's going to be on social media. And right now with AI, every AI company, what's the justification they offer? The AI business is going to be huge, trillions of dollars. And this is the pathway to insanity, right? Basically, nobody's asking questions. I let you use the big story, use metrics that nobody's seen before, get away with it. In the 1990s, when I used to do these sessions, peak of the dot-com boom, I would do a session on discounted cash flow valuation. The end of the session, somebody would come up to me very aggressively and say, you really cannot value Amazon.com using a DCF model, can you? And the way you knew what answer they wanted to hear, which is, no, you can't do it. You do whatever you want. And at the risk of grave personal injury, I would say, no, you can value Amazon with a discounted cash flow model. And they'd give me this look of total contempt. It's an academic. That's not meant as a compliment, right? You know what the subtext there was, right? You're an academic, you can talk about this stuff. I have to do this for a living. And after the fifth or sixth time of being called an academic, I got really pissed off. And I valued Amazon for the first time. I'm not going to show you my very first valuation of Amazon from 97, but I'm going to show you my valuation of Amazon from January 2000, because as I said at the start of this class, everything I know about valuation, I learned in the context of valuing Amazon. You're going to see the birthplace of the FCFF simple Ginzu model when I value Amazon. So let me set the stage. January 2000 was the peak of the dot-com boom. The NASDAQ had just hit 5,000. Nobody saw the cliff coming. Don't let them lie to you and say, I saw this in December 25th. I was doing an analysis. No, you just didn't see the cliff coming. And Amazon.com was the poster child for the dot-com boom. So AIMR, which is the parent organization for the CFA, came to me and said, would you be willing to do a webcast? This was a very primitive version of a webcast then, on how to value Amazon. They set up the camera up on the 11th floor. They had to have a whole crew in those days to create a webcast. So I'm going to give you a compressed version of my valuation of Amazon and use it as a vehicle to talk about the things I learned while valuing Amazon that I still go back to when I have to value a Palantir or the next generation AI company. Coming into 2000, Amazon had $1.1 billion in revenues. Let me pause right there. Is that a lot of revenues? 1.1 billion for a retail firm in the US is minuscule. Just to give you a frame of reference, $1.1 billion in revenues in 2000, Walmart had 250 billion. The Gap had 17 billion. This was a tiny retail company and was losing $410 million. The cast is set, right? You got small revenues and big operating losses. I'm going to ask you a question, which I started with in this process. Is it possible that a company with small revenues and big operating losses, is it possible for that company to become a valuable company? Yeah, at some point in time, every company is a company. So play it out. It's simplistic. Diksha, what has to happen to my small revenues?
You have a high growth rate so that your revenue.
I need big revenues. The growth rate just gets me there, right? I mean, my small revenues have to become big revenues and my losses have to become profits. Simple as that, right? You see, this is so incredibly simplistic. That's where I started. How do I get my small revenues to big revenues? I use a revenue growth rate. I estimated a compounded annual revenue growth rate of 42%. I'll come back and explain why 42, why not 45, why not 39. And I hadn't even finished saying 42% when the first pushback comes in. Those in that webcast, people had to email their questions. They weren't directly, they were listening in, but the first question that comes in is, how come you're being so pessimistic about future growth? I said, pessimistic? I'm making $1 billion in revenues into 41 billion. I'm increasing your revenues 40-fold. But you know why it sounded pessimistic? What were they comparing the 42% to? Revenue growth rate in the most recent year, which for Amazon was 200%. So the question we're asking, why you bring, what they missed was the compounded and the 10 years. I wasn't using 42% in year one, I was using 150%. But as I went through time, those growth rates decreased because scaling is an ugly beast. It kind of pushes down your growth rate. So I thought I was being upbeat. It's an upbeat story I'm making. I still have to justify why, why did I end up with 41 billion? Why not shoot for 200 billion, 100 billion? I'll give you my story then, but this is start of an upbeat story. They're losing money right now, minus 36.7% margins. Let's ask and answer the easy question. What's the value of Amazon if their margins will stay at minus 36.7% forever? They're going to crash and burn. They're going to go bankrupt. So let's get that out of the way. I put my optimist hat on. I'll be quite honest. If you're a natural pessimist, don't value young companies. You'll always end up with zero. Yeah, you find a pathway to zero. So I put my optimist hat on. I liked Amazon as a company in 2000. I liked the way Jeff Bezos was making choices. So I did assume that they would succeed as an online retail company. Let me be very clear. In 2000, I saw them as a retail company. I'll talk about my subsequent valuations of Amazon, what's changed since. And I gave them an operating margin by looking at successful retail companies, all of which were in the brick and mortar space. I went to the 75th percentile of margins of retail companies. Already you can see the upbeat story building up, right? 40-fold increase in revenue, 75th percentile of margins. That's a 10% margin. So I'm going to move the margins from minus 36.7 to 10. I'll talk about the intermediate steps I used to get from 36.7 to 10. But my company is now taking form in my spreadsheet as a large money-making company. There's one final loose end. To get my revenues from $1 billion to 41 billion, it's not going to happen effortlessly. They'll have to reinvest. Reinvest in what? I have no idea. Jeff Bezos had no idea. This is not about you asking management. And this is why when people say, can I ask management, can I talk? What exactly are they going to tell you, right? They're in a business, everything is changing. It could be acquisitions, it could be computer platforms, it could be logistics centers. But the one thing I do know is growth is not going to be free. They'll have to reinvest. And this is where I got stuck on this valuation the longest. How do you estimate reinvestment for a young company? I looked at every textbook, including mine, and tried to do it, but none of it worked. I said, why not take last year's CapEx and depreciation, just extrapolate? Who knows what last year's numbers even look like? I'd be projecting out things that you could not even sustain. You could look for industry averages, but remember the online industry averages on CapEx as a percent of revenue, depreciation are all over the place. And ultimately, what's my driver that drives growth? It's revenues, not income. So I knew that I needed to connect how much I reinvested to how much my revenues are growing. Hence was born the sales to invested capital ratio. It's a ratio that exists in accounting. It's called a turnover ratio, but they use it for a different purpose. Here I'm bringing it as a proxy for this is what I'm going to use to estimate reinvestment. And the nice thing is it's connected to growth. Because left to their own devices, what do founders and managers want to do? Give you higher growth rates. And I'm going to be the skunk in the room, said that means you got to reinvest more. And that I think is a reality check, kind of restraining that number. I used to sales to capital ratio of 3 and saying, where did that come from? I looked at Amazon's own history. There's a partial history of how they've grown. And they've been very efficient about growing because they use supplier capital often to fund their growth. I also looked across retail firms, not just online retail. And there again, I went to the 75th percentile saying they can invest more efficiently than a traditional retailer because they don't need the brick and mortar stores. And that sales to capital ratio is 3. That's going to be the driver for reinvestment. So we'll talk about the reinvestment each year, but it's very simplistic. Here's my advice when you're valuing young companies, keep it simple. Less is more. Adding line items will just create chaos when there's no need for chaos. So what's in that reinvestment? Everything, CapEx, acquisitions, R&D, it's all consolidated in that number. Adil, you had a question?
You
Yeah.
said you took 75%. How did you make that judgment, 75, 90? What's it driving?
It's your story, right? 90 would make them a really special retail company. Generally, when you get to the 90th percentile, you're talking about niche retail companies, luxury retail companies. You're not going to get there if you're going to be a general retailer. So you got to bring in the common sense perspective of where to put them in this based on the business model you give them. It's got to be consistent with your own story, right? So my losses become profits. I put in the reinvestment. You agree it's a pretty upbeat story? Take a look at my free cash flows of the firm in my upbeat story. My free cash flow of the firm in year 1 is minus 933 million. Year 2 is minus $1 billion. Year 3 is minus $1 billion. Year 4, minus, minus, minus. For the first 6 years, I have negative cash flows. Why? Because my story is so upbeat. The more upbeat your story becomes, the more negative your cash flows will become. Doesn't make them bad, doesn't make them good. It's just what it is. And there is an assumption I made in 2000 that in hindsight, I was a little too casual about. You have negative cash flows of about $1 billion each year for the next 3 years, right? What do you need to do? Raise capital to keep going. And in 2000, I'll be quite honest, a dot-com company needing to raise $1 billion capital, that's pretty easy. I ignored the possibility that even if my numbers came in exactly as expected, that the capital markets would shut down. Because if that happens, you're not going to get to year 10 and the terminal value and all that neat stuff. So maybe in hindsight, I should have put in a failure rate, but in 2000, I was not building in failure rates into my DCFs because I didn't know any better. So in my upbeat story, Amazon makes it through the worst of times, raises capital, and the value that I got for the assets is 15.2 billion. I had cash. There's almost no cash. Shows you how confident they felt about being able to raise money. I subtract out debt, almost no debt, which makes sense. They're a money-losing company. I'm almost done, right? I've got a value for the equity. And then I subtracted out employee options. Now, do you see why I made that stopover and say, what do we do about the deadweight costs of giving away options like free currency? They've given away pretty much a quarter of the company because they were so free about issuing options to managers, to employees. And though that equity is not under my reach as a common stockholder, I take it out, I divide by the number of shares, I get a value per share of $35. With every one of my valuations, I'm going to let you ask me the question after I'm done with the valuation. The question is going to tell you whether I believe my own valuation, that I have faith. My value with my upbeat story is 35. The stock is trading at 84. Ask me the question. Clearly, I'm not buying, right? Did I short? And this is exactly the question that the webcast ended on. I was almost going to turn off the webcast and say, oh, we ran out of tape. In those days, they had no idea how this was being recorded. But I gave them the answer. I said, not in this lifetime. And of course, the follow-up is, do you not have enough faith that I was more convinced that Amazon is overvalued in January 2000 than I've been in most companies I've bought which are undervalued over the last 20 years. So why am I unwilling to put my money behind my words? But you can say that about buying as well, right? So complete the thought, it has to converge. But when I buy, when does it have to converge by? That's a flow. Like a time horizon where I can wait it out, right? But when you sell short, what do? You borrow other people's shares and you agree to return them when? Whenever they ask you. So I did call around. You could see this question coming a mile away. So I asked around with brokers as to how long they would give me if I sold short. 6 weeks was the most I was able to get because in early 2000, .com stocks were in such high demand, 6 weeks. Now, do you see why I said not in this lifetime? Not only do I have to feel confident that Amazon is overvalued, I have to feel confident that the correction will happen in the next 6 weeks, and there is zero chance I'm doing that. And that points to one of the great asymmetries in investing. When something is undervalued, there is a long-term buy and hold bargain basement strategy. It requires a long time horizon, but there are people out there with it. When something is overvalued, there's often not an equivalent long-term way of taking advantage of your point of view. It's better now than it was 20 years ago. You have some stocks have leaps, which are long-term put options. But in general, it's much more difficult. So what does it mean? Bubbles, when they form, will be far more likely to be upside bubbles than downside bubbles. Do you think housing is overvalued in 2007? What exactly are you going to do? Sell your neighbor's house short? I don't even know how this works. Can I borrow your house for a couple of months? But there were people who were creative about trying to take advantage of it, right? I teach 2 of my classes in a room that is funded by one of those people. How did John Paulson make money? He basically found a way to short housing by using traded securities as a vehicle. It required a lot more work than obviously going long, but that was the advantage. Very few people did what he did. And the 4 billion or 3 billion or whatever he made paid for that room and a lot more. And so if you find overvaluation, it's much more difficult, but not impossible if you can find a creative way to take advantage. And to discount these cash flows, I forgot to mention, I needed costs of capital. Keyword is costs of capital. Why costs of capital? Is my company changing over the 10 years? It's going from small money losing to big money making, right? And if I'm being consistent, what should you see in my cost of capital? A high cost of capital upfront, 12.84%, almost entirely equity funded. And by the time I get to year 10, cost of capital reflects a much more mature company, 9.61% cost of capital. Be internally consistent. This is not about something you want to do. This is your story, and your discount rate should reflect your story. So what I'd like to do is take that Amazon valuation and kind of dig in a little deeper and talk about the lessons I learned from this valuation that I still bring to valuing young companies. First, remember what I said about betas? I said, don't trust regression betas. That goes in spades when you're valuing a young company. And here's why. This is the Amazon regression beta from 2000. So there's a 2.23 raw beta. If you keep going down, there's a standard error of the beta. Can you read? It's kind of fuzzy. What does it say, man?
30.
No, it's the standard error. That's the standard deviation. 0.5, right? So my raw beta is 2.2. My standard error is 0.5. Think about what I've just told you. The true beta for Amazon can be anywhere from 1.2 to 3.2. It's insanely noisy. There's nothing you could learn by running a regression. So how did I get the beta for Amazon? I used a bottom-up beta, but I used 2 sets of companies. For the first 5 years, I used the bottom-up beta of online retailers, arguing they have higher fixed costs, they're younger, there might be other issues. But then by the time I get to year 5, you've got $15 billion in revenues and you're making money. You're now retailer first who happens to be online. I move the beta towards a retail beta. Are you allowed to do that? Valuation, it's up to you to justify what you're doing, but essentially it's principle driven. You can essentially define bottom up based on the company. Second, and this was the big page in terms of the 42% compounded growth and the 10% margin. When I first valued Amazon, I valued the way we're all taught to value companies, which is work sequentially. You know what I mean by sequentially? You do year 1, then year 2, then year 3. This is how most discounted cash flow valuations go. And I discovered that as I went from year 1 to year 2 to year 3, I was getting more and more into this. I have no idea. I'm getting. So if I kept doing this, I'd have pulled all my hair out by the time I got to year 7. So I said, this isn't working for me. I'm going to step back. And I have to rethink how I forecast cash flows. So what I'm going to say next is going to sound mildly Deepak Chopra-ish. I hate the guy, so kind of take the Deepak. To value young companies, you almost have to visualize what a successful version of that company will look like. So what the heck are you talking about? What's my story? That they're going to be an online retail company, right? So what does a successful online retail company look like? And you know how I got the answer? I went and looked at the 20 largest retail companies in 2000. The largest was Walmart, and I worked down the list. And I said, where on this list would I expect to see my vision of Amazon show up 10 years from now? You think that's subjective? Of course it's subjective. Everything in valuation is subjective. Get that on the table, knock it off, and then go back to estimating things. I said, will it be as big as Walmart? In my 2000 vision of Amazon, I said, no, they're not a discount retailer. They're not going for low margins, high revenues. I said, will it be as small as Ann Taylor? I said, no, it's more than just apparel. I went back and forth, and I finally put them between the 5th and the 6th largest retailers in the world. So went 5th and 6th, not 3rd and 4th. It's my story. You want to make it 3rd or 4th, make it your story, right? I don't own the story. This is my story. My money is riding on it. I'm going to make the choice. And guess what the revenues in the 5th and 6th largest retailers on an inflation adjusted basis was? About 41 billion. 40 and 42, I went right down the middle. 41 billion. So I know my starting number, 1.1. I know my ending number is got to be about 40 billion. Saying, how did you come up with all these growth rates? I made them up. You didn't mishear me. I just made them up. And if you made a big deal about any of those numbers, I'll concede it to you. So in year 1, you say, I think it's winning 163.35%. You can have that. You want year 2, you can have that too. If you let me control the ending number, I control this valuation. So in young companies, big disagreements are about the end game. What do you think this company can deliver in steady state? Not about the year 1, the year 2, year 3 numbers. So that's how I got my revenues from 1.1 to 41 billion. Then let's turn to margins. My starting number is minus 36.7. I want to be to 10. And I'll tell you the one thing I did not want to do. I didn't want to be estimating year 1 margins, year 2 margins, year 3 margins. Again, it would have driven me crazy. So I turned my spreadsheet on autopilot and said, fill in the middle. But I had to give it some guidance. So I gave it an algorithm, and I'd like you to guess what that algorithm is that allowed me to get such precise margins. How did I get minus 13.35, minus 1.68, plus 4.16? Anybody want to give that a shot? How do you think I got those numbers?
You're taking the end number and then you're just subtracting it out from the top one.
Okay, so I started, so let's work it through. My starting number is minus 36.7. What do I want to be at the end? 10. What's the distance between the two? 46.7. I took half the distance to my goal. I'm at minus 13.35. When you get to half the distance, you're saying, why half the distance? Why not? When I design valuations, I designed them for people to disagree with me. What is this half share? It's a part of my story about the pathway to profitability, right? And it's a pretty smooth pathway to profitability. But let's say you agree with every other part of my story, and this is the part of my story you don't agree with. You say, look, it's going to be a lot more rocky than you think. You know what you should do? Diksha, what should you do to the half? Make it a quarter. What does it do? You lose money for a longer period before you turn things around. If you're really upbeat and optimistic, set it to 1, in which case what will happen? You go from minus 36.7 to plus 10 next year. It's the simplest device. I could have set some exponential log normal function, but then you're saying, what do I do to this to make it move in the direction? So when you set these adjustment factors on spreadsheets, set them in a way in which people can see what's happening. It's pretty transparent, and you can change it. So my loss my minus 36.7 becomes plus 10. And as my margins go from negative to positive, my losses become profits. The last column, I've computed the after-tax number. In the first 2 years, I lose money, so I have no taxes. In year 3, I make money, but I still don't see me paying taxes. Why? Because I track my NOL and I keep it in my cash flows. I've seen bankers often take NOLs and set them to the side, and after they're done with the valuation, do all kinds of gymnastics about what do I do with the NOL. The value of an NOL is very simple. It saves you taxes in future years if you make money. It's in my cash flows, and I don't have to worry about NOLs as long as I can track them. That's why in the Ginzo spreadsheet, you see that NOL line item. Most of you are not using it. If you have a money-making company, a money-losing company, ask you for the starting number, and then as you lose money, that starting number will get the NOL will get bigger, and then when you start making money, I apply it. And as I'm doing all of this, I have that 10-year horizon. Every time I value a young company with potential, I get challenged on the 10 years. And you can see what the challenge is, right? Why only 10 years? And especially when you have a company like Amazon, where you have the benefit of hindsight, well, you've known it's grown for 25 years. It seems incredibly pessimistic. So I'm going to start with the reality. In 2000, I don't know who the winners and losers were. I liked Amazon. So I had to look at what I knew then. And what I knew then was how long growth lasts at a typical growth company. And I'm going to give you the results of a study done of IPOs a few years ago by somebody at Wharton, where they tracked the revenue growth in IPO and compared it to the growth of the peer group. So 1 year after the IPO's revenue growth is 15% higher than the peer group. See, that's good. I bought a growth company. 2 years later, that difference is down to 7%. 3 years later, it's down to 3%. By the time you get to year 4 or 5, you can't tell that IPO apart. Most growth companies, growth fades 3, 4, 5 years. And I've used 10, which is already at the 90th percentile of growth periods for most growth companies. Do some companies grow longer than 10 years? Of course, the 90th percentile, there's a 10% that grow longer. Why am I not incorporating it? Because as an investor, I need something for myself. If I put in a 50-year growth period and I justify today's price, that's like signing a young baseball player at 19, expecting him to hit 50 home runs for the next 19 seasons, right? If you pay him that much up front. Then if he hits only 40 home runs, that's a negative surprise. If he lasts only 17 years, that's a negative surprise. So I'm going to stop at 10 years. I very seldom push past 10 years. The exceptions are sometimes with pharma companies, where you've got a patent that takes a really long time to kick in, but have a good reason for expanding past the 10 years. Yes.
The period matter in this because they're looking maybe at a certain period of the economy.
Doesn't matter. I mean, this study looks at IPOs across time, so that shouldn't be a factor. It's not one IPOs in a particular year, it's IPO spread over time. Good markets, bad markets. And all that we said about paying for growth in the context of traditional growth applies when you look at young companies. You know why people believe that somehow when you come to young companies, you don't have to think about any of those things anymore. So the reason I put in that sales to capital ratio is to hold you accountable. You want growth, you got to reinvest to create that growth. It does make my life easier that I've used the sales to cap, because all I need to do is take the change in revenues and divide by 3. And I do that every year. If there's a lagged effect, it's actually very easy to build in, right? Take the change in revenues in a future year and compute the reinvestment there. So year 3 will drive reinvestment year 1. Year 4 will drive reinvestment year 2. Sales to capital ratio is just your starting point for reinvestment, and you can build in all kinds of adaptability into it. And as I'm doing this, my spreadsheet is actually giving me feedback if I'm willing to listen. Because think of what I've done. I've projected out the margins and operating income in future years, right? I'm computing reinvestment based on sales. Remember, reinvestment becomes your delta in your invested capital. It's a change in your invested capital. So I keep track of what your invested capital is going to be based on what I'm reinvesting. I have after-tax operating income coming from margins and growth, reinvestment coming from sales to capital. If I divide the income by the invested capital, I get a return on invested capital. It's an imputed number. It's coming from my assumptions. You say, so what? What's my return on capital in year 10 for Amazon? 20.39%. The question I'm asking myself is, can I live with that? Is that a company that I think, and in 2000, I felt okay with it because the average retail company was making 18%. I was giving Amazon a slightly higher return on capital. But let's say that return on capital you're trying to be 200.39%. What's my spreadsheet telling me? You're not reinvesting enough, right? And if I'm listening, what should I do? I should go back and revisit my sales to capital ratio and reduce it to make my return on capital a number that I can actually live with.
Is there a possibility that sales per capital ratio can change?
Yeah. In fact, it can change over time, but it has to be something to do with the business model, right? Is it getting easier to grow as you get bigger? In some business, it might be. Is it getting more difficult to grow as you get bigger? You might have to go to less attractive markets. So it depends on the story and the business you're in. In this case, I didn't have any adjustment because the retail business is huge. But if you were looking at another business where as you grow, you're entering either less attractive markets or there's some networking benefit that makes you stronger, you build it in. So it doesn't have to be a constant. In fact, in the Ginzu spreadsheet, I give you 2 chances to do the sales gap, one for the first 5 years, and then for the next 5 years, because the next 5 years, we want to bring it up. So those are the things you think about of whether you should let those numbers be different numbers. Is this business going to allow me to invest more efficiently?
For like economies of scale, for example.
Yeah, see, but this is not economies of scale or operating margin questions. They're really not invested capital questions. This is about what do I need to create growth? So you can't use an economies of scale argument for sales to capital ratio. It's got to be something to do with business models and what you're investing in to grow.
Professor,
Yes.
in the Ginzo spreadsheet, the years to pay off is either 1, 2, or 3. If I want to enter like 7, 8, or 9 for a pharma company, can I do it in that?
You can, I mean, in a sense, the spreadsheet just takes in typical sale, right? So I use the growth rate to get revenues each year. You can take the revenues and replace them with year by year revenues for the next 5 years if you feel that you're in a position to forecast them out. So just remember, once you hard code those numbers, you're kind of locked in. So if you're going to enter revenues by year, create a separate worksheet with revenues by year. Read from that worksheet. So when you want to change your mind, you're not going into the main valuation spreadsheet and changing hard-coded numbers. Because everything in that actual valuation spreadsheet, none of the numbers there are hard-coded. Everything comes from something in your input sheet. So you want to enrich the input sheet, go ahead. You can break a business down to 3 businesses and create 3 lines for revenues. It's a starting point, not an ending point. It's an open spreadsheet. You can go in and adjust. Yes.
Going back to the sales over capital ratio, I'm thinking something like network effect may be possible, like as the business.
That could be. So business could get more attractive, at which point Uber might be able to get more sales per dollar capital, in which case raise the sales to capital ratio as you go to the second part of the valuation.
I'm also imagining it can also accelerate the revenue growth. So the
Don't double count though, because in a sense, if you're going to do a growth story, you've already told your growth story. This is about what do I need to invest to get the growth. So if you use networking benefits to push up your growth, that's fine. But then you got to tell me how those same networking benefits are, because you're counting in it for a second benefit, right? Not only are they making you grow faster, they also make you grow more efficiently. And that's a different story that you got to tell, right? With Uber, that second part of the story might be more difficult to tell because the way they grow is they go into a new city that they fight to get more market share. So that part of the story might get more pushback on. Now, along the way, is there going to be some dilution in my story? What are my cash flows for the first 6 years? They're all negative cash flows. And those negative cash flows will require more shares to be issued. You're saying, how do you know they're shares and not debt? Because you look at my debt ratio for the next 5 years, it's 99% equity, 1% debt. I'm telling you what they're going to use. It's going to be equity. So I'm confessing there'll be shares issued in the future. There'll be options. Those options will get converted to shares. So that's going to add to your share count as well. And if you remember, I actually divided the value of equity by today's share count. I seem to be in denial about those future share issuances, right? But am I? Why not?
Negative debt.
Because those negative cash flows of the first 6 years, remember that 15.1 billion value that I got for Amazon's equity by discounting the cash flows? It would have been 20 billion if I hadn't had those negative cash flows in the first. I've actually reduced my value, discounted my value by 25% because they have negative cash flows. That's the dilution effect already in my present value. If I take that value and divide by this adjusted share count that counts the shares I will issue to cover those negative cash flows, I will be double counting. Same thing with options. What did I do with options? I took the value of the options, I reduced the value of equity. I agree there'll be options shares outstanding because of those options, but I'm not going to count those because I've already reduced my value of equity today for the value of the options. There will be dilution, but I just don't care because it's already in my equity value today, my value per share today. Diksha?
We should always look at value per share instead of the value of the entire company. Because
You're an investor. Remember, you're doing this as an investor, right? You don't buy the entire company. I don't think, unless you have a lot of money, 3 trillion, you get on Schwab or you get on Fidelity and you say, I want to buy 1,000 shares. So ultimately you do value per share because you compare to price per share, right? Because leaving it at the generic equity value is neither here nor there, because what am I going to do with that as an investor? So you do have to do things on a per share basis finally. And even if you're an acquirer, that's what you buy, right? You go buy shares at a particular price. So publicly traded company, I don't see anywhere around the fact that you need a per share value, not just a kind of collective value for all of the equity. Now, as I said, I was a little upbeat in that valuation and not factoring in failure because we know failure is a clear and present danger. The Bureau of Labor Statistics maintains this, I think, incredible database where they track the number of startups every year around the US, broken down by sector, and then they track them every year afterwards. So this is the 2006 cohort that they've tracked for 15 years after the startup. So how do you read this? Let's take a sector, the retail sector, right? If you track all of the companies that started in 2006, 16.9% failed within 1 year. 47.9 failed within 2 years. That's why those bleaker stores you walk by, 2 years from now you walk through, they're not going to be there, half of all retail. And if you look at what percentage of firms make it to year 10, about 31% of retail startups make it to year 10. You see, what's magical about year 10? That's when we put a nirvana and a terminal value. And this is saying, be careful. A lot of companies don't make it to year 10. There's a failure risk here. In 2000, when I was building spreadsheets, I didn't have that in there. And I realized very quickly, maybe in 2001, that this was a clear, sometimes you need a reminder, hey, you're missing something big. In 2001, it reminded me of that because I saw failures all around saying, why is my value off? Because I didn't factor the failure risk. I'm not suggesting it's going to be an easy number to estimate. And once you go public, the risk drops off fairly dramatically because you open up sources of capital. The larger you get, the lower that number becomes. I know it's not fair, but you get too big to fail. All those things will feed into the failure risk. It'll also affect if you're valuing a company in a capital market where there are lots of restrictions. You're valuing an Argentine company, the value attached to the same company will be lower than in a market where there is access to capital. It gives you this number that captures those risks. So I finished my valuation, and there must have been somebody in the audience who owned Amazon. She said, is it possible that Amazon is worth $84 per share? What's the answer to that question? Possible is such a weak word. Yeah, of course it's possible. In fact, I can tell you how to get there, right? What are the two big drivers of value? Revenue growth and margins. If I put in higher revenue growth, have an end margin and a higher margin, I'm going to get there. See these shaded areas? Those are the combinations that deliver a value higher than the stock price. At 60% compounded annual growth rate will make Amazon the second largest retailer. So this is embedded in these break-even points are stories. The question you got to ask yourself is, am I comfortable making Amazon the second largest retailer in the world while giving them the margins of a more niche retail company? Because that combination is what you need to get And my answer was, look, I can give you break-even points, but I don't think they're possible, but they're not plausible or probable. You can always compute break-even points for any company. It's a good idea to do it after your evaluation to say, hey, what does that number have to be? Now, as you're doing all of this, Julian?
Be very rational about how these companies grow. Like, it's like, price, like, these are very unlikely, but I feel like you've given us a couple examples where like lighting is struck like multiple times. And so
The same company, you mean?
different companies that are like, oh, well, what if this company was worth something, but like, oh, it actually was 100x worth 100 times more. Like, sort of initially.
Do you remember the things that lightning did not strike, though? I mean, the problem as human beings is we hold on to memorable companies. We forget about I forget all those dot-com companies that I looked at even in the late 90s, right? So I'm not saying you're wrong, but I'm saying sometimes we overestimate the likelihood of success because the companies that we remember are the companies that are successful. We tend to very quickly in our mindset to the side. All those other companies that we thought were going to be promising companies that have kind of faded. I'll wager 5 years from now, you probably say, what, Peloton? I don't remember that company. But remember that COVID boom of Peloton. So I don't disagree with you, but the question then you got to ask yourself is, what is it that sets these lightning strikes companies apart from the rest? And is there a way I can assess that into one of the numbers, right? Maybe, so
Like someone in the dot-com era said like some retail company will be worth $1 trillion. Like the sector will be worth $1 trillion. You'd say, well, maybe some like the sector will be collectively, but like it seems like you can find like one person will sort of achieve those wildest dreams.
you know what, early on, the assumption was that one of the existing retailers would end up dominating. Just like in the PC business, what is the early bet on who the winner would be? IBM, right? Now, so sometimes the companies, so right now I ask you who's going to be the winner from AI, the answer seems obvious. It's NVIDIA, it's Microsoft. 10 or 20 years from now, we look back at AI and say, who was the real winner? Could be very different. I mean, I look back at what I thought in the 90s, is early in the 90s, Cisco winner, you're going to have AOL a winner. That didn't last very long. So I'm not disagreeing with you that you can make trend, and that's what Kathy Wood, in a sense, that's her entire strategy, right? She picks a trend and she picks a company that she thinks is going to be the winner in the trend. Her valuation skills are abysmal, right? But her trend spotting skills are really good. So the question is it what's the company she owns? DocuSign, and one of the companies she owns. I mean, clearly she's onto the trend. This is a trend where we're going to, I mean, every big document I've signed in the last 2 or 3 years has come through. So clearly this is a trend. More and more of our documents are going to be sent digitally. You need signatures. You need a company that can back it up. Will DocuSign be the ultimate winner? She's made that bet. But I think that that second part is a lot shakier than the first part. So I'm not disagreeing with you about trends and eventual winners, but I think it's actually a lot more difficult while you're in that space, figuring out who the end winner is going to be.
And you don't think that like looking at Amazon in 2000, it's still talking about 55 years later, like there was something about Amazon that was special, or you're
Yeah, in hindsight, I think it's one of the most amazing companies ever, but that's the hindsight of having watched it go through maturing. It looked like it was maturing as an online retail in 2010. I'll talk about what changed and how the story for the entire company changed. I think it's one of the most amazing companies in terms of narrative and how we've shifted narrative over time. Now, as you're doing all of this with a young company, what are you saying? I could be wrong. I could be wrong. I'll save you the trouble. You're definitely wrong. You're going to be wrong 100% of the time. And it's okay. It's not your fault. Because things will come out, things about the market, the company. And the reason it's okay is you don't have to be right to make money. You just have to be less wrong than everybody else. It's what brings the anxiety level down when you value young companies. In fact, with Amazon, this played out in real time. I valued Amazon 2000, dramatically overvalued. And I did the little song and dance of I can't sell short, not time horizon. A year later for AIMR, I revalued Amazon, but this time in a very different setup, right? The dot-com boom had bust. And they said, at this in 2001, the question was, will any dot-com company ever be worth money again? So I revalued Amazon. And my value went from $35 down to about $20 per share. So you think that's terrible, your value changed that much. Well, what did the market do? It went from 84 down to 11. And now it's trapped. You know why, right? What's the question? Are you buying? And now I can't do any song and dance about time horizons. I bought Amazon for the first time in 2001. And here, this old nostrum from value investing of you just buy and forget. You know the thing about just buy and hold for, don't do that with companies like Amazon or Tesla or Nvidia. These are not the kinds of companies where you buy and forget because the value is changing, the price is changing. So guess what I had to do in 2002? I had to revalue the company. You can't take the original valuation and use it again and compare to the price. It was still undervalued, so I held on to it. 2003, the value actually almost doubled, but the price tripled. It's time for me to leave. I bought Amazon 5 times in the last 25 years. I've sold Amazon 4 times in the last 25 years. So I've kind of given you a clue of where Amazon is in my portfolio right now. But this is a company I've gone in and out of because there have been times when it's been cheap and times it's expensive. Yeah. If I'd held it for all 25, would I have made more money? Maybe. Yeah, but that would not be consistent with an investment philosophy. It says buy when something is undervalued, sell when something is overvalued. As you know, I sold Tesla. Doesn't mean I will never own Tesla again. No, at the right price, I'll come back in, but not at $230 per share or 225, whatever it is today, 220, 215, 210, no, whatever happens. So it basically means that you're adapting. Now, I very seldom do this. With Amazon in 2014, I went and looked at the actual numbers and compared them to my forecasts. Remember, my forecast are the 2010 number. My projected revenue is 41.3 billion. Their actual revenue is actually lower, 34.2 billion. They were undershooting. And then you look at the margins, I projected the margin to get to 10%. Their actual margin was 4.11%. But they were moving to it. And I assumed in 2010 that they were now going to slide, take them longer time, but they're going to get to it. And then in 2011, the story kind of broke because the company started behaving as if it were back to being a startup. In what sense? They were reinvesting more, they were selling at closer to cost, their margins decreased, their reinvestment went up. And the question I'd ask is, have they gone crazy? Or are they becoming, it's like a transformer movie, right? Basically, are they transforming into a different business? In 2012, the story I told for Amazon shifted from being an online retail company to a disruption machine. I don't think Amazon can be put into any business anymore. They're a disruption machine. What do? They target soft businesses, and then they go for your softest underbelly. Do they make money? Not necessarily. When I talk to companies about Amazon getting into businesses, look, if Amazon gets into your business, I don't have any idea whether they will make money, but I know one thing for sure, you will all make less money than you did before. Which is one reason when Amazon enters a business, you look at the market reaction to the other companies in the business, the day they bought Whole Foods, the collective market cap for all grocery store companies, that includes Walmart and Target, which get a significant portion of groceries, dropped by about 30 billion on that one day. The day Amazon was allowed to operate in Chile, Chilean retailers lost 25% of their market cap. So in hindsight, am I going to beat myself up? I remember presenting this valuation in 2015 in front of a group of bankers, and one of them puts up his hand and says, in 2000, why weren't you building a cloud business in for Amazon? I said, the only clouds I was thinking about in 2000 were up in the sky, right? You can't use the benefit of hindsight saying, why didn't you put an AI into the NVIDIA revenues in 2015? I had no idea AI was coming in the form it was. You can only do what you can do in terms of what you know then. And this is a more recent valuation, but when I value companies, I try to visualize something that'll help me kind of remember the story. So with Netflix, I think I've mentioned this before, what I see is a hamster on a wheel. because this is a company that's keep producing content to get subscribers, you get more content. So I don't know how you get off the wheel, right? With Amazon, when I see the company, I visualize my favorite Avengers character, Thanos. I like the bad guys. My grandchildren don't even get this. My guy said, "You don't like Captain America?" I said, "I like Thanos. The guy has depth, right? He's clearly misunderstood, badly treated." I mean, I see Thanos and I see the finger click and I see multiple businesses going to dust. And then I remember that every time I see Amazon act. And I'll tell you the one thing as an investor in Amazon that could potentially stop them. It's not another company. I think head to head, I can't think of another company in the world that can win against Amazon. You can win against in niches, Costco in a segment of retail, Alibaba and Chinese online retail. The one thing that can stop them is a regulator or a government. And you know what's going to allow regulators and governments to stop them is the rest of their competition will go in front of the government and say, you got to save us from this monster. And that's going to essentially be the one thing that can act as a check on Amazon. So young companies clearly a challenge, but you can see that they're interesting, they're evolving, they're shifting, and you got to adapt with them. Let's talk about valuing mature companies. Mature companies are usually easy to value because they have a long history and they're set in their ways, right? Can you get set in bad ways? Every morning when I wake up, while I have my coffee, I have a Linzer tart. Horrifically bad breakfast, full of sugar, lots of jam, and I'm probably killing myself. But I'm set in my ways. I like that Linzer tart. Do companies have Linzer tart-like problems? Yeah, sometimes as a company, you get set in your ways. And over time, those ways have become bad ways, but you keep doing it. And with mature companies, the problem is if somebody else comes and says, you need to stop doing this, and they have enough power to change the way the companies run, you now have two pathways the company can take, right? Keep doing what you're doing, call it the status quo, and a second way in which they could do things, which could yield a very different value. So let's look at how this plays on the question. Whenever I ask a question of a company, then you can give me two possible answers. One is they keep doing what they're doing. You get a value, status quo value. So what are your cash flows? What's your growth rate? How risky are you? When will you be a mature company? And then I can ask you a second question, which is, if you change and you become a different company, what will the answers be? And you get two different answers. Trying to put both into the same valuation is messy. So here's what I'd suggest you do. Value the company twice. Once with the status quo and once with it. So I'm going to take an example. It's a company called Hormel. You know what Hormel does or makes? Really disgusting stuff. In fact, I think they've created the most disgusting concoction that passes as food. You know what I'm talking about, Michael?
I think so. I think it's the salami and the cheese wrap.
It's actually Spam.
Oh.
Spam is this meat in a can, I think, which can last forever. Think about it, meat that lasts forever. I don't even want to think about how you get it done. But Hormel the company was built around Spam. So they should have monuments to Spam, a statue of Spam, or whatever you need to do. But it's a company that, like many other food processing companies, was family owned, became family controlled, and now the family has moved on, and a foundation for the family actually is the largest shareholder, but it's a very conservatively run food company. How does this play out? They reinvest very little, and they reinvest only in the US. Their whole world is, the US is our market. No, let's not look elsewhere. And they don't borrow much money because they don't like to borrow money. So status quo, low debt ratio, very little reinvestment. You give them low growth, cost of capital that reflects a low debt ratio. The value that I got was about $32 per share. But could they be run more aggressively? I think so. One is they could use a little bit more debt. And I'll talk about why I picked the 20% as opposed to 10%. It's not just a higher debt ratio lowers the cost of capital. In this case, it did. And I also assume they could be more aggressive about their reinvestment, go for more growth. Again, I'm not being completely outlandish. The growth I'm going to give them is 5.6%, not 55%. slightly higher growth, slightly lower cost of capital, the value that I get is $38. I have two values for the company, right? If you're a passive investor, there's only one price. Let's say it's right in the middle, $33. It's lower than the status quo, higher than the optimized value. Which one are you going to use in comparison? Depends on corporate governance, right? If you think you can change the management. If you think there's zero chance of changing the management, you're stuck with the 32. If you think there's 100% chance, you're saying, what's going to give me that property? Would it make a difference if I told you Carl Icahn has accumulated some shares? That might alter your property to a great, not guaranteed. In this case, what kept the probability of change low was the Hormel Foundation, the largest single stockholder. The person who ran the foundation was also the CEO of Hormel. Kind of undercuts any chance that there would be change here, right? So I left the property at 10%, and my expected value worked out to be about $32.50. Hershey's looked very much like Hormel until the foundation decided to be the activist. They said, we're not making much money. Our wealth is all tied up in this. They actually were the ones pushing for change. So that's what's keeping the 10% there is even a foundation might wake up and say, we're invested in this company. We want it to be worth more. Now, incidentally, for those of you in our corporate finance class, the way I come up with how much debt a company can have is not use the lazy assumption of more debt is always better than less debt, right? I've heard that from Carl Icahn, I remember in 2012, told Apple to borrow $300 billion. And he said, if you borrow $300 billion, it costs you only 3%, it's much cheaper. The only thing was that 3% was the cost of debt, the debt that they had, which was like 20 billion. You borrow 300 billion more, there's zero chance it stays at 3%. Your cost of debt will go up, your cost of equity will go up. So what I effectively do, and we've already laid the foundation for this because the way we get betas is with an unlevered beta and a debt ratio, is I compute the beta at different debt ratios, giving me higher cost of equity. I compute a rating for this company at higher and higher debt ratios. Not surprisingly, as my debt goes up, my rating decreases. And I come up with a cost of capital. The reason I picked the 20% debt ratio is my cost of capital kind of hits a floor around 20 to 30%. And I said, beyond that, I'm actually going to increase my cost of capital. So that 20% debt ratio really reflects it. Last piece for today, dealing with decline. Let's look at the question. What are your cash flows from existing assets? If you're a declining company, what do you see? Revenue shrinking, margins under pressure. What's the value of growth? You start laughing. What growth, right? That was back in the past. How risky are you? Depending on what you're divesting and paying off, your debt ratio could be shifting, your business risk could be shifting. You know, when will you be a mature company? He said that was 20 years ago. Now I'm just hoping to just survive. So one of the challenges you face when you're valuing declining companies is if those companies see declining revenues and shrinking margins, they're run by sensible management. What's the pathway they should adopt? Get smaller, shrink and see if you can survive as a much smaller company. If they're run by ambitious people, visionaries, God help you. A declining company run by a visionary is a recipe for disaster, right? Because then you're going to make ambition to become a young growth company. You're going to do acquisitions. You could drive even that limited value declining company is to zero and below. So you have to take a stand on who's running the company and look at the management and say, are they, it's a question I ask myself when I look at Intel now. It's a declining company. Maybe it can find its way back. I'm going to be looking at the actions taken in the next few months to see what pathway they're going on, because I don't want them to go back to being TSMC or try to be NVIDIA. They can't do that anymore. So when you value a declining company, that becomes the factor. So I'm going to take an example of Bed Bath and Beyond. When is the last time any of you were in that godforsaken place? I remember the first time I walked in, we say Bed Bath, you expect what? Clothing and sheets and towels. You walk in, this is the Beyond, I guess, captures all the rest of the stuff. Right? You walk in, there's a refrigerator in the front, there's furniture on the side. It's like a department store gone crazy, right? With no organizing principle. But for a while, it was one of the fastest growing retail concepts in the US. I mean, I lived a few miles away from the original Bed Bath & Beyond store in Springfield, New Jersey. It's like a destination. It's like the last blockbuster video. I think it might still be around. Visit it, walk in. And you're going to very quickly see why the concept died the way it did. So this is a valuation I did a Bed Bath and Beyond, where I valued the company. This was like 2 years ago. Its base year revenues was 7.9 billion, but they'd been declining over time. So I said, you know what? I don't see an end game here where they're going to go back to growing in the near future. I actually continued with the decline. I made them a much smaller business, and I said, you can maybe become a niche business with some people who like this concept, but it's going to be a much smaller bit. Over time, though, I did assume that their losses would converge. So in my story, I'm essentially making them a smaller niche company with margins they can sustain. The value per share that I got was, you can work out the value somewhere or other, 3.3 billion for the equity. But remember, this is a declining company with a lot of debt. There is this very real chance that they will not make it. So where I incorporated that was I brought in a risk of failure. How did I get the risk of failure? I got lucky. They had a rating, and if you have a rating, I can back from the rating what the chance of failure is. And given the rating, it was, I think, single B, B plus, I looked across, and there's a S&P and Moody's both update these studies. How many of those companies within each ratings class make it to year 10? It's a 24% chance of failure. What will my equity be worth if they fail? I can almost guarantee it'll be worth nothing. You take the expected value, the value per share I got was 323. The stock was trading at 879. Of course, it's now, the equity is worth nothing. The company's pretty much done. But I was trying to value declining. And you can see why a story is going to be, a story of shrinkage and hope. In fact, in some cases, you shrink the company and you got liquidated at the end of year 5 or 10. There's no end game here. So with declining companies, it's really that psychological effect of how do I, when I talk to people who do valuation for a living, I ask them a very simple question. When was the last time you valued a company and put in a negative revenue growth rate? And the answer usually is, I've never done it. Which is interesting, right? Because there are companies that shrink. How come you never run into these companies? So leave open that door. And one final thing is, even if you do things reasonably in evaluation, you get a DCF value, there is this very real chance of failure you got to bring in. You're going to so you almost have to complete the process, an estimated likelihood of failure, and what you will get as an equity investor if you fail. So I know I'm hitting the clock here, but I'm going to show you a valuation I did of a company called Las Vegas Sands. Familiar with this casino company? And I hate to generalize, actually, I love to generalize, so I'm going to generalize anyway. Casino companies tend to be run by megalomaniacs. This is my anecdotal evidence. You take Wind Resorts, and this is a company run by a guy called Sheldon Adelson, company that grew a lot in the 2000s, and then 2008 hits and the bottom falls out. They have huge amounts of debt. So when I did this valuation, I valued them at $8.12. I fixed them on the spreadsheet by doing what? Increasing the margins, reducing the debt. I made them a healthy company, but there were stories swirling around that they might not make it. So I finished the valuation. I come up with 812. I fixed the company on my spreadsheet. The stock price is 425. So Adil asked me the question, am I buying? I said, I'm not even tempted, which led to some soul searching, which is, what am I missing? And the answer is, this $8.12 is the value for Las Vegas Sands if it survives and gets back to health. And all the stories around me are saying it might not be the case. So I estimated probability of default, and this will be the last thing for today, by doing two things. One is doing what I did for Bed Bath & Beyond, using the rating to estimate it. But Las Vegas Sands also had bonds outstanding, and there's an interesting way in which you can back out from a bond price the chance of default. The price of the bond, you got the coupons and the face value. You can solve for the likelihood of default by just discounting it the risk-free rate and saying, what is the chance I would not get the coupon? And the answer there was truly terrifying. The bond market was telling me there's a 77% chance that Las Vegas Sands will not make it. You take an expected value in both approaches, you're bringing in the fact that your equity is going to be worth nothing. They default. So with distressed companies, that's why I have that failure risk number. So if you have a company that's distressed or young and you want to bring in the risk of failure, bring in through that. So I'm going to end on that note because you have everything you need to value a company. So you go across life cycles. So be creative, don't be afraid to be wrong, and make the best judgment.
Seems like 30 cards.